The complete video to ATR indicator. ATR is commonly used to show volatility, one of the most important concepts in the financial market. Volatility. It is loved and hated in equal measure by traders. There are some who specialize in making money when the markets are volatile, our guide about this, and others who love it in a period of low volatility. There are several ways of seeing whether a market is volatile or not. First, you can observe the market visually to see your preferred assets are trading. Second, Wall Street traders observe the SIBO Volatility Index, VIX. This is one of the most commonly used tools. Third, you can use the many volatility-based indicators to measure volatility. In this article, as we said just above, we will look at one of them, the average true range, ATR. The average true range, ATR, is one of the many indicators that was developed by Alexander Wilder. He first wrote about the indicator in his book, New Concepts in Technical Trading Systems. Other indicators that he suggested were the Relative Strength Index, RSI, Parabolic SAR, and the Directional Movement Index. These indicators were developed with commodities being in mind. Wilder was known for being a successful trader in corn and energies. Commodities are also known to be more volatile than stocks. Therefore, this volatility leads to significant gaps and limit moves. The chart below shows how the ATR looks like when added in a chart. A high ATR figure is a sign of high volatility, while when it is falling, it signals reduced volatility. As with most indicators, it is not mandatory that you know how they are derived. What you need are three things: how to apply them on a chart, change the period to suit your trading strategy, how to interpret the indicator. What is average true range used for? Volatility is an important concept in the financial market. It simply refers to the degree of movement of financial assets within a certain period of time. For example, assets like Bitcoin and Ether are more volatile because their prices can rise and drop by more than 5% within a session. On the other hand, some stocks like Berkshire Hathaway are not volatile since they don't move significantly in a session. Long-term investors make most of their money when a stock is rising slowly over a long period of time. As such, they are not fond of volatility. On the other hand, day traders love volatility because of the significant opportunities it creates. A good example is what happened during the coronavirus pandemic in 2020. Since there was a lot of volatility, many investment banks and hedge funds that have large trading accounts generated billions of dollars. Therefore, the average true range, ATR, can tell you whether there is volatility or not. Other indicators that show or measure volatility are Bollinger Bands, historic volatility, Donchian channels, and the relative volatility index. There are several ways of seeing whether a market is volatile or not. The ATR indicator is not a trending indicator now. A mistake traders make in how to use ATR is to assume that volatility and trend go in the same direction. Nope. Recall, the average true range indicator measures the volatility of the market. This means volatility can be low while the market is trending higher, and vice versa. Here's an example. The S&P is trending higher while volatility is heading lower. How to use ATR indicator to hunt for explosive breakout trades. Before it occurs, here's a fact. The volatility of the markets is always changing. It moves from a period of low volatility to high volatility, and vice versa. This means that when the market is in a low volatility period, you can expect volatility to pick up soon. So, how do you use this knowledge to find explosive breakout trades for ATR trading before it occurs? Here's how. Wait for volatility to reach multi-year lows. On the weekly time frame, identify the range during this time period. Trade the break of the range. Here are a few examples. Brent crude oil multi-year low volatility followed by a break of support. Eurozone multi-year low volatility followed by a break of support. Do you notice how these explosive moves occur after a period of low volatility? Pretty cool, right? This is a hidden technique on how to use ATR. Are you sick of getting stopped out of your trades prematurely? Here's how to fix it.